my name is Amco and today we're gonna cover how to pick a stock. Yeah, I know, nobody knows what stock is going to do what, and you should just invest in an index fund or an ETF, as index funds outperform 99% of individual investors and almost 95% of the hedge funds managers. You've got to ask yourself one question.
Do I feel lucky? Well, do you, punk?
So what is market cap? Well, let's take this lovely pizza as an example. Let's assume that each slice of this pie is currently valued by the market at $3. There are 8 slices in total, so to calculate the total value of the pizza, you just need to multiply 8 slices times $3 per slice. So we get $24 in total. So that's the total value of this pizza, and in other words, that's what the market is currently willing to pay for the whole pizza. $24 is the market cap of this pizza if this delicious pizza was a publicly traded company or stock. So why does it matter? The larger the market cap, the more stable the stock is, and mostly means less risk. Although small market caps are more volatile and you take on a lot more risk, the rewards can be a lot greater as well. So it's mainly recommended to spread out your portfolio over the different size market caps if you want to take on more risk. A micro cap is $50 million to $300 million. A small cap is $300 million to $2 billion. A mid cap is $2 billion to $10 billion. A large cap is $10 billion to $200 billion. And a mega cap is everything above $200 billion. Market cap also helps us compare them apples to apples. Say you have 2 companies, Italian Pizzas and Belgian Pizzas. Italian Pizzas has a stock price of $30 and shares of Belgian Pizzas trade for $20. Now, which one is the more valuable company? You can't know without also knowing how many shares each company has outstanding. Say Italian Pizzas has 10 million shares outstanding and Belgian Pizzas has 20 million shares outstanding. Belgian Pizzas is actually a bigger company even though its share prices are lower. Hit the like button if you like any type of pizza. You can narrow down your search with a screener. Use a screener to filter stocks based on specific criteria, such as sector and industry. Screeners offer users additional features such as the ability to sort companies based on market cap, dividend yield, and other useful investment metrics. TradingView.com, for example, has a good free screener. So let's try to hunt a winning stock. So let's start by narrowing down our search. Let's click US. Let's filter down on industry. Let's say retail trade and click for industry, internet retail. And let's say we are only looking for mega cap companies. So let's set the market cap to a minimum of $200 billion. Well, now we narrowed down our list to Amazon and Alibaba. Let's have a closer look at Alibaba. Go to Alibaba's investor page and search and open the annual report. Revenue. We see that Alibaba increased its revenue by 34%. The next step should be reading about the company. Read about the different type of income revenues, check out the competition. Does it have an edge over the competition? Make sure you understand their business. The next step should be checking out their balance sheet. Make sure they have way more in cash and investments than they do in debt. If the company has more in debt than in cash and investments,
abort mission.
As when the economy goes bad and they are already in debt, they will not get any loan and they will go out of business. Are the revenues and profits going up over the last 3 years? Only buy stocks where the revenues are an upward trajectory over the last 3 years. Read the risk factors in the annual report. Don't underestimate the risk factors. This might be one of the most important things to understand of the company before buying their shares. So make sure you feel comfortable with the risk before continuing to the next step. Then read the last quarter report to check if the company is trending or they are suddenly making a lot less revenue. If, for example, the last year they would do plus 20% and now they are minus 5%, then this stock would not be the one for you. Google the company news. There could be lawsuits, new product announcements, things that could influence its price. How much do you trust the people at the top of the company? Long-term strength and stability. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. So don't freak out if you couldn't buy a certain stock today or yesterday when prices were lower after some news, because you should be buying for long term. If it's all good news up to now, then you need to check out its forward PE ratio, the price earnings ratio. As a general rule, the lower the PE, the safer or more conservative the stock is. The reverse is more noteworthy. The higher the PE, the greater the risk. The price earnings ratio can help provide market value. The PE ratio helps you analyze if a stock is undervalued or overvalued. It gives insight into a stock market's value or its worth according to financial markets. To find the PE ratio, divide the company's share price by its earnings per share. If a company is trading at $40 per share and the earnings per share are $2.50, the PE ratio is 16. PE ratio can be helpful to compare companies in the same industry or sector. The forward PE ratio from Alibaba is less than Amazon, for example. So is the PE ratio realistic? Then head over to the next step. Yippee-ki-yay, motherfucker! So the price of Alibaba already looks interesting. And if you are looking into the charts, as you can see, the price has crashed. Well, this is due because the US government has been discussing delisting Chinese stocks and creating FUD, fear, uncertainty and doubt. The second reason is the Chinese government itself, which has a lot of power to control the company if they want to. Biggest reason is that you're not actually buying any real assets or legal claim to the assets. You're buying a shell company in the Cayman Islands that has no real assets. So when the US government decides to delist Alibaba stock, you get nothing. Nothing at all. Beware, I'm not a financial advisor, I'm just a crazy guy you found on the internet. Seeking out expert opinions via news sources is time consuming, but it can yield results. It will deepen your understanding of the industry fundamentals. It also may alert you to interesting smaller companies that don't turn up on screeners or within ETF holdings. At the end of your research process, you may be left with a single investment prospect or a list of 10 or more companies, or you may decide that this industry is not right for you. That's fine. All of that research may have stopped you from making a bad investment. Decide what you want to do with your portfolio to achieve and stick with it. Pick an industry that interests you and explore the news and trends that drive it from day to day. Identify the company or companies that lead the industry and zero in on the numbers. Diversify. Don't buy more than 15% of your portfolio of just one stock. Some people like studying the charts and some people throw darts at the board to pick a stock. Scientists did an experiment, fund managers versus monkeys, and found out the monkeys outperformed the fund managers in stock picking. Subscribe if you want to see me throwing darts. Go out.